Basically, this is the process in which today we have 5 promoters. We have Enact, which is Genworth's. Genworth is a firm which was originally GE Capital, and GE Capital, when GE decided to divest their insurance businesses, Genworth was formed. Enact is the American arm of Genworth. Sagen is another Canadian mortgage insurance company. So they are our 2 largest shareholders. NHB, ADB and IFC continue to participate as minority shareholders. So we are incorporated as an NBFC with the RBI. The regulations that govern us are specific to the mortgage guarantee industry. We now work with nearly 23 lending institutions. We have about 150 employees, and we have guaranteed nearly 20,000 crores worth of housing loans. Our regulation allows us to guarantee only home loans. We are not allowed to guarantee any other asset class, and this is in line with the regulation internationally also. So these are some of the milestones in our journey. In 2008, the regulations were drafted. 2012, our company was formed. 2014, we did our first deal. 2017, we started crossing the monthly run rate of 100 crores. 2019, we started crossing a monthly run rate of 300 crores. We also had more than 100 employees. We also conducted something called the India Mortgage Leadership Conclave, where we get all industry crores a month. We have offices in Noida and Bombay. We have employees in nearly 30 plus cities in the country, but offices in only 2 places. In South, we have about 23 employees across Chennai, Bangalore, Hyderabad, Coimbatore and other towns. So what do we actually do, and what is the value that we bring? As many of you would be aware, housing is the second largest contributor to economic growth after agriculture. And if you look at the Indian economy also, we are now growing at about 6.5% a year. But housing is growing at double that rate, 11 to 12%. Housing is good both for financial inclusion, housing is also good for economic growth. So what do we do to promote the housing ecosystem? Firstly, if you look at it from the customer's perspective, the customer gets a wider range of lending institutions to choose from. Because in line with the lender's risk profile, a customer's opportunity to borrow from more lenders goes up. They are also able to take a home ownership early. From the perspective of the ecosystem, we are able to ensure financial stability because we are coming in as a third-party shock absorber. In a normal housing lending transaction, it is between a lender and a borrower. We are coming in as a third party with an independent capital base to act as a shock absorber in the event of default. And from a lending institution's perspective, it is quite obvious they are able to expand their risk box. They are able to lend to people they were earlier not comfortable lending to, and in the event of losses, we are anyway there to cover. Plus, as more and more lending institutions are moving to the Ind AS form of accounting as per the regulation, they will also get a significant benefit on their expected credit loss, because our guarantee is loan amount. The expected credit loss can be nearly zero because we will cover it unconditionally and irrevocably. So as more and more people move to the Ind AS accounting regime, they will begin to recognize the expected credit loss benefits that come with an unconditional guarantee. So the borrower benefits, the ecosystem benefits, the lending institution benefits. So these are some of the lending institutions we have tied up with. Our largest contributor is LIC Housing. We have just started off a pilot and a project with SBI. We work with a whole host of NBFCs. We work with Piramal, who has taken over the DHFL business on the retail side, and they are growing significantly into becoming a large affordable housing player. We work very closely with Aditya Birla Housing. We have just tied up with Federal, which we hope will give us a toehold into the south market. So one of the things, if you notice about the housing finance ecosystem, it is that the top 5 players control nearly 65% of the market. So between SBI, HDFC, ICICI, Axis and LIC Housing, 65% of the market on new originations is controlled by 5 players. So there is some level of asymmetry that exists. 50% of the housing origination is in just 6 to 7 cities. So we believe that with a product like ours, where we have an average ticket size of just 19 lakhs, we believe that with a product like ours, we will help people go deeper into interior geographies where they are currently not comfortable lending to the extent the opportunity exists and drive financial inclusion. So if you look at our current ticket size of 19 lakhs, it is down from 26 lakhs 4 years ago. So we are progressively bringing our ticket size down by doing more and more affordable housing lending, which is in line with the charter for which we have been created. So this is some of the, we have just categorized the areas where we are able to add value. One is the profiles. We are able to permit people to lend to unskilled workers, blue collar workers. Many people do not give full loan tenors to those working in small enterprises. We do loans to vendors, vada pav, samosa vendors. We do loans to hawkers. We do loans to auto rickshaw drivers. All of these are profiles which earlier were not part of the formal lending system, and we are contribute in our own way to kind of expanding that box. People are usually not very comfortable in Gram Panchayat locations or locations where which are away from town limits. As long as a valid mortgage is creatable, we help people expand their collateral box also. We are able to give people higher loan tenors. I gave you the example of the retirement example. We are able to give people better loan amounts by, usually what banks do is they will assess your debt burden and they will have their own norm of what is the highest debt burden they are willing to cover. So your income is 100, your debt is say 40. So people will look at a debt burden which they will be willing to cover. With a guarantee, they are able to consider a higher debt burden. So again, your eligibility goes up. People in the informal income sector, again, get the same set of benefits. So one data point here is 85% of our portfolio is Pradhan Mantri Awas Yojana eligible. So which is, again, we have been set up with the purpose of promoting financial inclusion. The Pradhan Mantri Awas Yojana is one of the most impactful schemes of the government. It has been extremely popular and continuously extended. So 85% of what we lend is Pradhan Mantri Awas Yojana eligible. So this is in a snapshot. These are the numbers that are there. We are growing over 30% year on year. We have benefited over 1 lakh customers. We've done about 5,000 crores last year. We expect to do upwards of 9,000 crores this year. Our average loan size is 19 lakhs. We have paid out 1,100 plus claims last year. Claim payment is a big testimony and the moment of truth in any insurance or guarantee business. We have a capital adequacy of 38%, so we are well capitalized. We have strong shareholding. We currently have enough capital for the next 3 years of growth, and we have committed shareholders who will continue to invest in this business because they see the opportunity that this provides in the long term. Many of us would know that the housing outstanding to GDP ratio is considered to be a universal measure of an economy's health. And India, we have been at a 10% mortgage outstanding to GDP ratio for a long time. If you look at developed countries like the US, they are upwards of 60%. Or Thailand, they are all in the 18 to 25% range. So we believe that growth in housing finance or growth in housing will be a key catalyst when we get down to when we are chasing an 8 to 9% GDP growth. And as we build scale, we will be a significant contributor to this growth journey in the overall economy of the country. Nearly 30-35% of our origination last year is from South. We guarantee across 200 locations in the South. We have benefited more than 18,000 borrowers and borrower families. Our average ticket size here is a little higher because so far our concentration of lenders here are with those who operate in urban areas. The average loan to value is 60%, which is in line with what it is in the industry. So I think I have kind of mentioned the opportunity, and we have just fine-tuned it a little bit to see what we can do in the South. So if you look at it, we have a housing shortage of nearly 41 lakh homes, which is 22% of the country, which is existing in the South. And as people progress into more deeper geographies and lending institutions, we believe we will play a strong role in kind of filling this gap and helping the underserved get housing loans. I'll take a pause here and open myself for questions if any of you have.
Profits. What I understand is you make over and above any interest rate, you work at a margin of 0.25% if I am not wrong. So how do you? Third question is, what is the volume of or the share of loan for which you provide guarantee?
So the first question is yes, guarantee is not compulsory or mandatory in our country. In many other countries, it is mandatory. For example, in the United States, any loan greater than 80% loan to value, mortgage insurance is compulsory. In Canada, it is a compulsory product. In many European countries, it is a compulsory product. In India, it is not a compulsory or not doing because you are not compatible. Use us as a backstop and do it. So we work with every lender with a different product. So it is not like we have 5 set products which people can choose from. Every lending institution has a risk appetite and every lending institution has a target segment. For example, SBI today, with nearly 23% market share, want to increase their self-employed levels. Self-employed lending is considered to be riskier. So they are doing 3-4 things to help them grow their self-employed segment. One of them is to use IMGC for one part of the segment. So for those, every loan that they do in that product will come to us. So that is how we generate business. So 20% is a sweet spot where it works out to about 1.25% for the life of the loan to the borrower. So for the borrower, it is a 17 rupees per lakh of EMI that he has to pay to get a higher loan amount or a lower interest rate. So that is how the pricing works.
Few more questions. When you, as far as a bank or any lender is concerned,
the customer is declared NPA, which is 3 months outstanding. We pay immediately for all the 3 months. Okay, so the loan gets, so that they get their cash flows. In the 4th month onwards, we keep paying, but we also have to get regular proof of recollection of collection efforts from the lender. Otherwise, there is a moral hazard. Because if you have to repossess from 2 customers, one has a guarantee, one does not have a guarantee, the tendency will be to first go after the person who does not have the guarantee. So in order to prevent the moral hazard, the banks submit efforts of their collection activity every month to us.
Sir, you are planning for your own model on the lines of...
The reason for talking of a score, and it's actually different from a bureau score, is or 35% of affordable housing borrowers are credit untested, which means this is their first introduction to the banking system. So there is no bureau score available for them because they have not had any lending history. So then how do we underwrite these loans? Today they are being underwritten anecdotally, today they are being underwritten through subjectivity and so on. We have data of 23 lending institutions with us. We are continuing to build scale. We will have application data, we will have portfolio data, we will have claims data. Ultimately, the richness of this data is something nobody else will have in the industry for housing. So we believe for the non-credit tested customer, we will create a score which will act as a substitute for the bureau score in the non-credit tested customers. This score is already ready. For it is very important to test the score for a long time before making it a commercial proposition. We are already testing it with a lending institution. In about 12 months' time, we should be ready to roll it. In terms of direct to consumer, it is still premature. We are at a very, very early exploratory stage where we actually do not plan to go direct to customer. What we felt is we could work at some stage when we have adequate traffic. We could work as a place people come to explore their options on a housing loan. I would say that is not on the horizon for at least the next 3 years. I am mindful that there was some media coverage on it, but I think the timelines that I was talking about got lost somewhere. So it is very exploratory right now. I think it is only when we cross the 1 lakh crore portfolio that this opportunity will come. But as a whole, at this stage, difficult to say. And all I can say is it is going to be after the next 3 years.
So at the moment it is.
Or a lower interest rate. Lower interest rate will come because he will go to a lending institution where he is ordinarily not eligible. So the borrower pays the fee. The fee is built into the EMI. It, on an average works
So
out
it
to
is, sorry to interrupt, it is the lender who gives him the option.
Correct.
That's how it works.
Correct.
So quite obviously you are assuming a big risk. So what instruments do you have to defray this risk? Do you reinsure?
First, right now we do not reinsure. And the RBI's regulations are such that we need to ensure tier 1 capital at all times. So to that extent, our entire provisioning, reserve, everything is done with tier 1 capital. We do not have any debt or even mezzanine debt. We are a debt-free company. At this stage, we do not reinsure. For the next few years, we have enough capital to provide guarantees without needing to reinsure. It is very likely that when we run out of capital, we will get more capital from existing shareholders because they are fairly invested in this business in the long term. We use certain, what value our international shareholders bring is they have seen mortgage markets in various countries. And therefore, we have developed risk modeling and algorithms which tell us how to price. And that is an evolving journey.
So is there a concept of underwriting profit here?
So,
like we see in the other insurance companies?
I do not know what the term underwriting profit means, but I'll tell you that what we do as underwriters in our shop is every loan, once it's underwritten by the lender, we also underwrite. We provide a second pair of eyes. And that does two things. One, it gives the lender the reassurance that in a slightly risky profile, somebody else has also done in the tires and checked the efficacy. Second is, it brings greater consistency. Because inconsistencies get called out quite quickly when two pairs of eyes look at it. So, I won't say we make underwriting profits. As a term can get misconstrued. But we are in discussion with certain lender partners where they are saying instead of us doing the second level underwriting, now that they have developed trust in our underwriting practices, if we could do the bulk of the underwriting and then pass it on to them to do their checks and do. So those are evolving models. That is called a associate underwriting model. We are not there yet.
So typically for every 100 crores of loans you guarantee, what would be your income?
So on an average, 1.2%.
1.2%.
Yeah.
That's your gross, your top line.
That's right.
And you make profit by investing it.
By investing it, yes, correct.
So do you disclose your profits?
Not yet. But see, actually, this is the first year we are about to make profits. So far, we were not making profits. The gestation of this business is slightly higher. So for the financial year ended March 31st, 2023, is the first year we are likely to make profits. Our audited financials should come up end of this month. So this will be the first year where we are likely to break even and make profits. So from here on,
you will be profitable, confident you will be profitable.
We are confident because the certainty is upfront and we take it into a P&L over a 6-7 year period. So the certainty of cash flow is there. Plus, we are quite confident that we will grow, like this year we are quite confident we will grow upwards of 70%. Because we have had a couple of tie-ups that will give us a lot of volume. And once we start growing at that level, if we maintain the expense discipline, then we are confident we will stay.
So the way you grow is to add more and more lenders in your partnership. Is
One
that how
more,
it is?
one is more and more lenders. Second is increase penetration to the same lenders.
Right. What's your capital base?
So we have a 40% capital adequacy. So our capital
That's like what is that?
is
Quantum.
just below 400 crores.
Quantum. You started 10 years back, and still we haven't scratched the market. Why this slow?
So
Housing sector is said to be a booming business. Others are making a whole lot of business. Why are you? And
so-
that is out of 1,100 claims. What is the quantum?
quantum I don't have offhand, but I'll share it with you at the end of by the end of the day.
And a 400 crore, even if you invest in a 400 crore, you must be earning a whole lot of sum as investment income. As you are saying that you are going to make profit only now. Why?
So the primary reason is the hint lies in his question, which is that this is a concept which needs selling. And if you look at any new concept,
Why to sit and talk?
I like to exploit my height. But I'll sit down when I'm a little tired. But I'm enjoying this.
Yeah.
So if you analyze any new concept, it has always taken 7 to 8 years to for the market to absorb it. And I'll give the example of credit bureaus first, because it's an industry I worked in. It's a very similar industry. When credit bureaus started, banks were not convinced they had any value. 2-3 things kept happening, which is what led people to see value. First, defaults. Second, regulation. From the time CIBIL was formed to the time a second credit bureau came, was a gap of 11 years. Because it takes 11 years for a market to fully appreciate a new concept of any nature. If the guarantee was mandated, let us say the government says, or the regulator says, any loan greater than 80%, it is mandatory. Then I wouldn't even need to go and sell the concept. We are seeing a similar journey. One, COVID gave people a temporary source of worry.
That was 2020.
No,
You
I
started
understand.
in 2009.
No, we started 2014, which is when we did our first deal. So the reason it takes time is because lenders have to see value in the proposition, which means one lender has to convince the other criminal, which is how we create the market. And the time that we have taken has been the experience of mortgage insurers all over the world. This is a product which takes 7 to 9 years to break in. And reality is, if you see the last 4 years, which is where you pick up traction, we have been growing 40-50% year on year. The reason profits take time is because of the nature of accounting. I collect the fees upfront and I spend the money upfront, but I can't take all of it into my P&L in year one. So we have been making operating profits for the last 4 years. The reason we are making accounting profits this year is because now is when it is flowing into our P&L with the right ratio. We have been operationally profitable for the last 4 years, where the fees we collect is more than the expenses we make. Our investments are very tightly regulated. We cannot invest in equities. 25% of our investments have to be in public sector bonds, government bonds. So our investments are very tightly regulated. So it is not like we can make huge amounts of investment income. And it is also fair that our investments are regulated, because our primary responsibility is to have enough capital when the claims come. So our investment is also guided by the regulation. It's very clearly laid down. We can't go and invest where we want. Plus, given that our shareholders have seen the 2008 crisis in the US, we actually keep more capital than the regulator asks us to. So our capital adequacy has never dropped below 20%. Right now it is 40% because we just got capital.
What's the minimum?
10. Our product compensates when the borrower is alive or defaults.
How many companies are there in this business?
So we are the only place.
You're the only one.
Yeah.
Are you asking the regulator to make this mandatory?
So, okay. This is a tricky one. We are engaged with the regulator to see what kind of benefits can be provided if people take mortgage guarantee. As of now, I won't say that. These are conversations that happen. So it's a little difficult for me to.
Are you asking the RBI to make it mandatory or not? That's
No, so the RBI, we are not asking them to make it mandatory.
You're not?
No. For housing loans only, and we believe that there is enough opportunity in housing loans alone to be very profitable in this business. And more importantly, there is a lot to be done in promoting management. As you can see, our ticket size is steadily declining. Ideally, we will be happy if the ticket size is between 12 to 15 lakhs. I also believe that there is a huge impetus to push affordable housing and housing for all by the government. But if you see public sector banks today, the average ticket size is 27 lakhs. We believe that with some of our public sector tie-ups, and we are in active engagement with at least 2 right now, in addition to SBI, we believe that we will help that journey. Because the sweet spot for affordable housing is between 12 to 15 lakhs. There is a massive public sector distribution of 20. So even the refund process, with no lender we have seen it. So the moral hazard thing, while we have it, I can tell you hand on heart, not seen any. No. So we also have a condition where before selling the property, they need our consent, so that we don't become a default haircut mechanism. It has worked seamlessly with all lenders.
So when you say,
PMAY eligible. PMAY has a cap of 30 lakhs.
yes, correct.
So 85% is 30 lakhs, and beyond. So why would the ticket size be 12 lakhs? 85% is less than 30 lakhs. So
No, that's what. See, when you say your average ticket size is 90
1 lakh.
I mean, 19 lakhs is what you said.
Yeah.
So assuming that the property cost is 15 lakh.
50.
Yeah, 50. That is affordable. I mean, they have a cap, right? So 20% should be 12.5 lakhs.
Yeah. So I'm not talking of our guaranteed portion. I'm saying the ticket size of the loan.
No, ticket size of the loan.
Correct.
Okay. What is the guaranteed size of the loan?
20% of
20% of it.
Yeah.
I mean, of any amount for the
Correct. So see, when I say any amount, that is where we have seen the main lenders with whom we have started operations, which is State Bank of India, and now we are in Federal Bank. So if you see, when we've added new lenders in the past, we have doubled. So there was a stage where we did 1,200 crores in 1 year and 2,400 crores the next year. So when we've added one large lender, we have had incidents of our volume doubling. Therefore, we are quite optimistic about this number coming through. In terms of, because SBI's ticket size is a little higher than 19 lakhs. So if our overall percentage growth is say 75 to 80%, number of customers added may grow by 50 to 60%.
So now one last question. Taking it from his question, see, if you look at the mortgage business is concerned, if you look at US, you have only 2 companies, right?
US?
One is Sagen.
No, Sagen is Canada.
No, SAGN. I just discussed it with this, right? Means there is a company. So similarly, in Canada, you have a few companies. Why it should be restricted to only one company in India? Why
No.
more players cannot enter?
They can enter. It is when they want to enter. So the US has 4 players actually, 4 large players and then a few other players. Some other people went under in 2008 because they didn't have enough capital to pay when the housing finance crisis hit the US. So there is no restriction on when this comes. You have to also understand that in Canada, for example, the government is a very large player in the guarantee space. In India also, if you see, while the government has not entered the mortgage guarantee space, in the MSME space, there is a CGTMSA scheme which is quite successful, which is helping us also. Because once people see the value of guarantee as a product to expand their portfolio, it helps everybody in the market.
If you increase from 20 to 28%, what will be the impact?
The guarantee, it will be a fee impact. So the average of 1.25.
Why not they go up? Why it is 20%?
Because that is what the lender wants. We are okay to give 10, 20, 30, whatever the lender wants. But the lender believes that 20 is the sweet spot.
No, if I am a borrower, if somebody guarantees 30%, then 40%.
My outflow will be higher on fees, and which the lender to structure the product.
And one more point. Interest rates are going up or have gone up till now. Do you see more defaults happening? Economy is
So
may not.
when we say lenders, interest rates have gone up, we have to see it in a bit of context that they went down to 6%. which is the lowest that housing finance rates have been in the last 30-35 years, perhaps ever in our history. So they have somewhat corrected from 6% to now 8.5% to 9%. The housing industry 20 years ago had three categories. There were speculators, investors, and end users. For the last 7-8 years, speculators have gone for the last 10 years. Investors also are gradually reducing because the certainty of asset price growth has kind of softened. So right now the housing industry is largely a end user driven market. As a result, I feel that at current rates, it may not stress the borrowers to the extent it is feared. Once it crosses 10%, this is again an opinion that 10% is what my opinion is, that once they cross 10%, there is risk of default going up. The affordability currently, I don't see getting stressed to a point where it will impact defaults. What is happening is demand is getting impacted. In the lower end of the segment, as your interest rate goes up, your eligibility comes down. And therefore, in the lower end of the segment, people usually borrow to the maximum extent they can. In the medium to higher end, people put in their own money. So if eligibility comes down, they will take a lower loan, put more money on there. So you can also really see housing demand the way it is going right now. The increase in demand is only coming in the medium to high segment. In the lower end, it is impacting everything.
So affecting your business, no?
Not yet. Because we are still, when we become 10% of the market, then the macro trends will start affecting us. At our current scale, the macro trends won't affect us.
Right, insurers are issuing surety policies, or we have started, not like insurance companies have launched a surety for infrastructure projects. How about if they get into this space, will it be a competition for you?
Could be. I believe if there is competition, it will work well for everyone. So, for example, today when you say is 17 rupees per lakh high or is it low? It is one man's word versus the other. Once competition comes in, a certain consistency to pricing also comes in, and a certain consistency to market practices come in, efficiency gets better. So there is, I will be pretty happy if we get a better.
What's the plan for expanding our distribution network or office network?
So our office network, we first had only one office which is in Delhi NCR. We opened a second office in Bombay. Now we have opened a larger second office in Bombay. And what happened is that COVID taught us the value of remote underwriting or the opportunity of remote underwriting. Earlier, all our underwriters were based in Noida. Then we opened offices in Bombay and kept underwriters in Bombay. Now we have underwriters in Chennai, underwriters in Bangalore, underwriters in Hyderabad, underwriters in Coimbatore, underwriters in Kerala, who are working from home. So we do not know whether we may want to expand to one more office. If we do expand to one more office, we keep having a debate on whether the third office should be in Chennai or Bangalore. So there are pros and cons on both. So whenever we have a third office, it will be here in the south. For example, we could, it is still first loss, but we could come in a securitization transaction.
Sorry?
In a securitization transaction, we could come in as a substitute for the cash collateral. Because if you see, what a cash collateral does is it is only a credit enhancement mechanism. We perform exactly the same function. So in 2014, actually, the first transaction that we did was the portfolio DHFL sold, and there was a buyer, and we came in as a guarantor. And actually, that portfolio performed fairly well. So that is one way in which we could come in as a credit enhancement provider. If you read
substitute the RBI's cash collateral.
Correct. If you read the RBI's securitization committee report, they have also nudged in that direction about 3 years back. So we are in discussion with some people to see.
So you are interested in that?
Yes, very much. Okay, second loss, I don't know whether lenders will see value. See, for us, second loss means we have to keep less capital, we can price finer and so on. But lenders see maximum value in first loss. With lending institutions to define whom we will lend to. So there is no real negative profile, so to speak.